Hey, welcome back. It's Nolan Mathias from Mortgage 360, and today we're discussing news out of Borrowell that credit scores have increased during the pandemic. That's right, they went up, not down. And you would expect that during lockdowns, when income was going down, when everything bad was happening, that credit would not get better for most Canadians. But that is, in fact, what happened. And we're going to dive into why and what you can do to make sure your credit is on the upswing going forward. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where when we get to 25,000 subscribers, we're going to give away $5,000 to put towards somebody's TFSA or RRSP just for subscribing to this channel. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss the fact that people's credit scores went up during the pandemic. This is not what we expected to happen. I remember vividly in March of last year, sitting at our computer, getting up at 7 a.m. and sitting at our computers all the way through until midnight every day for at least 10 days, basically trying to help people wade through the credit ecosystem and what they should be doing to prepare for long-term extended lockdowns and a major reduction in income. Nobody thought for a second that their credit score was going to get better. In fact, the conversations we were having back then that basically led to this YouTube channel taking off were all around how do we make sure that people's credit is protected. And we had a lot of conversations around deferment. We had a lot of conversations around making sure bills are paid and restructuring, refinancing to get rid of credit card debt, and so on and so forth. We never thought that we'd be sitting here a year later with news that credit scores, after all that has gone on, have gone up. But that's exactly the news that we are getting today. And if you go and you take a look at both BNN and the Financial Post, they're reporting on the story because it is big news and it is somewhat contrary to what people expected. Going and taking a look at the BNN Bloomberg article, Canadian credit scores went up amid pandemic. The study says this is coming out of Borrowell. And basically, the numbers are really staggering. On average, people went from below average credit scores to fair credit scores of around 667 points, which what we typically say is anything over 650 is good. And that is what they're pointing out, is that most Canadians have had their credit score increase to above 660. This is really, really interesting data. They also go on to outline that missed payments were down by 33%. So there were a third less missed payments. And then moving on to the Financial Post article, average Canadian credit score improved during pandemic, Borrowell study finds. Again, goes through a lot of the same data. What I thought was really, really interesting though, was in this report and this article, if I scroll down to the bottom here, they point out, and maybe it's not quite at the bottom, but they point out that basically the people who had very low credit scores had a significantly higher risk of defaulting during the pandemic. So here it is, consumers with a low credit score were 432 times more likely to miss bill payments than those with excellent credit scores. So think about that. 2 times more likely is there's twice as much of a chance that you're going to miss a payment. 10 times as likely is 10 times. They're saying 432 times more likely to miss a payment if you were already in a place where you had a negative credit score. And let's talk about that for a second, because there's a reason for that. And the reason for that is if you're already in debt and you're already struggling on making those payments, the likelihood of you missing a payment goes up significantly. And I think there's some pretty clear things that this report tells us with respect to what you should be doing to manage your credit going forward. And I mean, let's start with the reason for this. Why were people able to make their payments? It's not because the government was giving out $2,000 CERB payments. Yes, that helped, but that is not the real reason why more payments were getting made and people's credit was going up. The real reason is because of the lifestyle changes. Basically, in March of last year, we were forced as an economy, as a country, as a society to reset how we operate. That meant not going out and spending as much money in bars, not going out and shopping as much, basically not spending money in a reckless manner like we had before. And that's the number one reason why credit scores have gone up, is because there was a massive lifestyle shift when everything happened in March of last year. And we're seeing that continue through to this year. Now, what's interesting is that we are starting to see people get back to their bad habits. And I think if there's a message going forward that most people need to heed, is that you need to really be conscious of those bad habits that you had previously and not going back into your old spending ways. Really think consciously about where you are spending your money now, because you have an opportunity to basically use that conditioning that you've had over the last year to stop making those payments and stop going out and spending all that money, and really think about consciously taking that conditioning and trying to carry it forward as the economy opens up. Now, the other thing that you need to consider is that the reason why people who are in trouble is because they've had to use credit. Now, sometimes they have to use credit for a reason. Maybe there's an illness, maybe there's a job loss, and that's fine. But a lot of people just get into credit trouble because they can't control their spending. They can't control their budgeting. And really, that is the number one problem that people who have issues with credit have, is that they aren't in control of their spending when it comes to pulling out that credit card and making that payment. And the reality of it is unless you're buying a house, and in some cases a car, but I'm very much shifting my opinions towards a house is probably the only thing you should really be borrowing money to purchase. But unless you're borrowing money for a house, you probably shouldn't be borrowing it on credit. Or if you are borrowing it or buying it on credit, and you're using that credit card to get points or whatever, you shouldn't be spending money that isn't already in your bank account. So what you shouldn't be doing is you shouldn't be swiping your card and going, well, I get paid in 2 weeks, so I'm covered. What you should be doing is going, okay, I have $500 in my account, and that is the maximum amount I need to spend, and I should be spending less than that. And the simplest and easiest way to stay out of credit trouble is simply to not borrow money for consumer debt, for things like credit cards, lines of credit, toys like jet skis, and all of the other, quads and what are the ones that go on snow, the ski-doos and whatnot. Those types of things are things that you absolutely shouldn't be borrowing money on. It doesn't take a very long period of time to save up for those things. Yes, you don't get it right now, but you can pretty much save up for anything you want to buy in a 3 to 5 year period if you just set your sights on doing that and not borrowing the money, especially cars, especially vehicles. People always buy cars and they go, well, I can afford the $800 payment. Well, $800 for the next 5 years, $800 a month is pretty much $50,000, $60,000. And what's to stop you from, instead of buying it right now, waiting for 4 or 5 years to purchase that vehicle and just saving up that $800 or $900 a month rather than borrowing it and have somebody else that you're obligated to make the payment to? Because once you're obligated to make the payment, there is that chance that you could not make it. And that's where your credit gets hurt. And that's where you start having to pay more for mortgages, where you start maybe not being able to get mortgages because you end up in a situation where you don't have a good enough credit to get it. And ultimately, it can have a pretty big effect on where you live and what you do. I can tell you one thing: in the crazy markets in Toronto and Vancouver and whatnot, people who have low credit are not getting into those markets very easily because they aren't able to deal with lenders, and they aren't able to do so in a way that is reliable, that they're going to actually get approved. So, I guess this is turning into a little bit of a preachy topic, and credit's always a preachy topic. But the reality here is that what Borrowell has found is 100% accurate, is 100% true. Credit scores did go up. They used the Equifax consumer scoring system, and that's the measure that they're using. And they are 100% correct that the scores have gone up, and it is primarily because of lifestyle. And when you are thinking about credit, what you shouldn't be thinking about is, I want this thing now, I want the computer now, I want the car now. What you need to be thinking about is, what impact could that have on me down the road if I'm not able to work, if something unforeseen like a pandemic shows up? And am I really willing to risk basically being able to buy other things like a house and the important things in the future in order to have that car or that computer or that toy right now, today? So, interesting news. This is all about lifestyle. This is all about habits. Tweak your lifestyle, tweak your habits, and your credit will thank you later. If you found this video useful, do me that favor, hit that subscribe button and hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about a race to 25,000 subscribers, where we're going to give somebody, not pay off, we're going to give somebody $5,000 to put towards their TFSA or their RSP. And you know what? Since we're doing a credit video, if somebody wants to take that money and use it for debt pay down, I'd be more than happy to let them use it for that as well.